Okay, so I mean, the big picture outlook is really similar. We're still getting tons of QE from all the major central banks. G5 QE or balance sheets are rising at very sharp rate to new highs. We're just getting new stimulus by Senate probably this week, next week, we'll get that signed by Biden, and that'll put the U.S. in the forefront of fiscal stimulus as a percent of GDP. So there's going to be more money flowing into markets on a big picture basis. Problem is that in terms of sentiment, in terms of fund flows, and in terms of positioning, markets are really getting to be pretty overdone. And so what that probably means is that we've got a much rockier path. The path will still be higher, but it won't be nearly at the same rate as we've had. We've had like an 80% run in the major indexes off of the March lows, and now we're starting to get some indigestion. And this first indigestion is really because one of rotation out of the former lockdown beneficiaries and techs that sort of led the first phase of the bull market to more of the reopening plays, the cyclicals, the things that are going to benefit from the reopening of the economy and the improvement of GDP growth. And so, as that oftentimes when you get a really big rotation like that, it accompanies a correction, and the big sort of impetus for this correction has been sharply rising long-term interest rates in the US and abroad, and investor concern that that's going to lead to higher costs for corporations that are big debtors, the growth companies, and it cuts the discount, which you can discount their future growth versus the interest rate, so their valuations are problematic, and of course it can lead to some earnings problems and things like that. So we've seen in this environment where we've got oil and commodities and energies and even then to a lesser extent some of the materials and some of the secondary cyclical plays doing pretty well and holding up pretty well, whereas the techs and some of the big growth stocks have been really getting hit. We do still see strong flows overall, and we've got tons of money market assets on the sidelines that will eventually join in to this bull market if we get a normal bull market phase. So there's still a lot uh, of, of liquidity going to be flowing into this market, but it's going to be tougher now, and it's going to be more picky. In terms of our supply and demand indicators, we've had the big decline in supply. This blue line is sort of our main trend indicator, and we're getting sort of the biggest correction that we've had off of March in terms of supply. It's still not retracing a huge percentage or anything, but on the other hand, it still hasn't broken below the late 2019 lows, which would tell us that we're in a sustained bull move. So we'd like to see that happen before we really go all guns blared for the bull market. But the demand has been very good. Demand has broken above all its 2019 levels and has made new all-time highs, and it's really not correcting nearly as much as supply. And so this gray line is the spread between the two, kind of the main trend tool, and you can see it had a big correction in that August, September, October period, and then made new highs, and it's correcting part of that way, and we would expect support somewhere in this area or anywhere earlier. But until this really breaks down, until supply really picks up more, and until demand really starts to fall apart more, we're still likely in this sort of what we will call intermediate term dominant bull market. And the idea here is that we want to wait for a correction over signal. We're still in a correction. And when we get that correction over signal, that'll be time to add exposure again. In the meantime, use your trailing stops and other tools to exit things that are not looking so hot, and you'll be able to rotate into the new breakouts once we get our correction over signal and start to get some base breakouts in new vehicles. So it's important at this stage of the cycle to start looking. We're sort of in this early recovery stage where we get leadership by industrials, basic materials, energies in particular, and some of the early phase like the consumer cyclicals and the technologies are starting to come off. And so you want to be rotating into these groups that take advantage of where we are in the cycle. So that's industrials, basic materials, and energies on the way up. And you can see in this is our new March ETF list, sort of what groups and sectors are leading. Underlined in red are ones that are in sync with those cyclicals, the industrials, materials, and energies. And underlined in blue are some of the ones that seem to be fairly resilient and are sort of in some ways able to hold up or benefit from the rising long rate environment. And we see the same thing on the stock list. Our stock list has rotated pretty substantially. You can see lots of red underlines and blue underlines that are holding up pretty well. And these are the types of industries and areas that you want to look for new base breakouts following a correction over signal to rotate into as you get trailing stops hit and other things that get you out of some of the former leaders. Right now we have potential bases in these stocks here, these 8 stocks here. I'm sure if the correction continues for some weeks ahead, we'll get many more of these. And so the early base breakouts from this list that are aligned with the cyclicals will be the prime candidates to take advantage of in the next rally phase. We still suspect we're going to get a decent rally phase. Consumers are in a pretty strong position, even though we've had a lot of financial problems from the crisis. Savings are really high, and people have been cooped up in cages for a year, and so they're going to want, as we get, if indeed the vaccine takes hold and it begins to lead us to more normalized behavior, which we're already seeing the beginnings of. If that continues, we're looking at somewhere between May and August for herd immunity to be reached in the United States first and in Europe second. And that's when you're likely to start to get much more normalized behavior and probably a heck of a spurt in growth. Perhaps the largest one we've seen since maybe the Reagan or Kennedy era after those big tax cuts. But that's not likely to last a super long time because what we've done in the recovery really off of 2009 is we've created a record percentage of zombie companies. And what that means is these are companies that wouldn't exist. They would go out of business really without artificially low interest rates and without bailouts and things like that. And what you do when you create a ton of zombie companies, this is the largest ever, 20% as a percent of US firms are zombie companies in some way, is you prevent the creative destruction that allows the new companies to emerge as the old companies are knocked out of business. And that's really where you get most of your growth. It's the new companies, the creative destruction, that really lead to high GDP growth for the entire economy and high job growth. And so we're really kind of not letting that happen. So there's a limit to how long we're going to go with the big growth. The other thing that we could get is a little bit of an inflation spurt. You can look at, here's the PCE deflator, which is a Fed's preferred inflation gauge compared to gasoline and compared to ISM composite. And in both cases, it looks like we're going to get a bout of higher inflation. It's probably not going to be the sustainable inflation that we were going to get down the road from this massive stimulus. It's more going to be a response of new demand kicking in and supply really having been constrained by COVID, and so it's going to take some time to catch up. So there's likely to be a temporary pop in inflation that'll concern everybody. The Fed has even talked about it, and then we'll kind of come off the boil. But year or two down the road, that's when we could get really sustained inflation kicking in. And then, one of the things that we've seen, the companies that are holding up and the areas that are holding up is that while techs are coming off the boil substantially, So a lot of commodities and particularly oil and energies have held up particularly well because they're smelling actual real growth coming down the road. And of course, OPEC has helped that out by constraining production until at the end of April. So there won't be production growth. And so you've got kind of this period where you can really see a pickup in oil demand. Oil is bumping up against this 66, 60, 67 area. It's a pretty significant resistance level, probably going to pause at least for some weeks. And then this 77 level is another really big barrier to get through. If we get the strong growth and we get the normalized recovery that everybody's talking about, we could certainly pop through these later in the year or into the following years, into next year. But these are going to be stopping points temporarily, and we can see that we're not at anything that economically, well, we're not at any kind of growth stymieing or anything that would stop the energy prices from still going. And then, we've talked about for a long time, over the last year, how we're likely to get this sort of bottoming of the commodity cycle that'll lead to a substantial burst. And we're sort of seeing the first beginnings of that. So now we will get up. We're not up to the median here, but we've certainly started, and we've seen actually relative strength of commodities versus the S&P. Starting in the summer and boosting. And of course, analysts are now talking about oil in the 80s. And I think there'll be more commodity shortages and things like that near term that'll help send commodity prices higher for a sustained period. Although, just like oil, the CRB is getting into a resistance zone. This 207 is very steep resistance, and really 204 to 207, we're getting close to that. And so we could see a pause. This has been a massive run up. Commodities are at an annual rate of change, growing at a 50% plus rate of change. That's very, very sharp. It's the beginning of a cycle, so it can get a lot sharper than it does at the end of the cycle, but that's still exceptionally sharp because we've got exceptional shift in growth. But I think this is a pausing point, and so you want to be careful. Maybe look for the consolidations or the back off to add new positions in the commodity space, but it's still going to be a space to look at carefully. And then if you want more exposure to energy and oils, some of the ones that really haven't moved yet but are likely to and are actually relative value in the space are Russian oil companies and Russia in general, which is now in a sort of a weekly cup and handle pattern. So we get a nice breakout above this handle pattern. That'll be a good signal that you can add via Russian equities. And some of the Norwegian energy plays are also very cheap compared to oil prices.